Hello and welcome to this edition of Forex Daily Dimes. I am your host Josh Lilquist, and welcome to the show. And today is your Wednesday edition, the 14th. Today I have a special guest on. It's a repeat offender and Forex trader, Mr. Walker England. How are you doing today, Walker?
Doing great, Josh. Thanks for having me back on.
Yeah, I know your time is valuable. You got a lot of things going on, so I kind of want to dive right into the topic here today. We talk a lot about, in trading and investing, you need a broker or you need someone that's going to fill your orders, right? And today's topic is life of a broker. And you were a broker for several years, right?
Yes, I was a Forex broker first. I worked for FXCM in a brokerage capacity from 2006 to 2011, I believe.
Got it. So a few years ago.
Yeah, it's been a while, but the memories still remain.
There you go. So I just want to ask you a few questions on like what life of a broker actually is. Like what did you do as a broker for one of the largest brokers in the world?
See, this is what people don't understand. A broker is really all of a catch-all role. And first, it involves getting up really early in the morning. And I have to say, some of the Forex brokers out there are starting their day at 3, 4 o'clock in the morning just to kick off a 7 a.m. shift.
Mm-hmm.
And the reason for that is their first priority is you have to stay on top of markets to relay that information back to your clients.
Got it. So it was, what are you talking like, the Forex market is open 24 hours, right?
Mhm.
So how did that really work with timing? Was it early morning U.S. time or what was that timing?
Well, the way we used to do it is break up the three major sessions and have three shifts of brokers. And you would have the typical US session or London overlap, and you would go into Asia, which is the overnight, and then you'd have the London market again. So, really, when you think of a Forex desk, typically you're going to have three shifts of individuals at any time working in their brokerage department.
Got it. Okay. And there's a lot of traders and investors out there that they always think that the broker is always after them, right? They're after their stops. They're after, every time they get in a trade, it goes the opposite way. Is that really what's happening with the broker? Are they looking at the retail trader? Do they even pay attention?
I'll be honest, in my experience, the broker frankly could care less. When I worked for FXCM, the whole idea is to get your order and pass it through as quickly as possible, because you have to think of Forex as the largest market in the world, and it truly is. I believe the last estimate from Forbes is something like $6.6 trillion changes hands every day.
Hmm.
It's huge.
Yeah.
So there's no real reason for the broker to hold your order and assume extra risk unless they really have to. Now, again, not to say that there's not unscrupulous people out there. I'm sure there are, but in my experience, your legitimate brokers, the ones that are financially backed and regulated, they just want to sit there and make the spread off of the buy and sell transactions.
Got it. Now you probably facilitate a lot of that. Now, what is the typical, I guess we'll say that typical trader and investor? Is it what's a good way to say this? Are the results the same? Do they trade the same as the broker typically trades?
Well, traders are typically an interesting bunch. And if you ask 1,000 people how they trade, you're probably going to get 1,000 answers. But what's nice about working for these big brokerages is because they can really open the books to that data set and see how traders are making their money, or better yet, how they're not making money.
Hmm.
And we had a short conversation before this about the statistics, and FXCM just recently published that 75% of their clients don't make money. So the question is, what are they doing wrong?
Yeah, it's probably the risk management, isn't it?
Well, part of it comes from risk management. The other part is traders typically like to pick tops and bottoms. And that can be a big problem in Forex, where you have some of these mega trends that last for years at a time. Again, we've seen this recent turn on dollar pairs, and just look at something like the Aussie dollar, which has been running up for the last 6 months. Now, will that continue or not? I don't know, but what the typical trader does is sell into that strength, and they compound their losses over and over and over again.
Yeah, it's kind of like the, people are trying to pick bottoms after a crash. Or, I mean, I'm sure there's a lot of people out there that have been, like, especially in the stock market, have been
Mhm.
saying, oh, the market can't go up any higher. Well, you have to have a proper strategy based on current market conditions. I mean, it probably won't go up, for forever. Forever it probably will, but it may have a drop. But if you have a strategy for any market condition, that is the key to, I guess, to be a consistent trader.
No, that's true too. And the problem with that is that the risk management discipline becomes a factor. It's fine to pick tops and bottoms. Don't get me wrong. I'm not disparaging traders that pick the turns. But the problem is when you finally get the turn right, you've got to have the money to trade it, and you've got to hold on to it long enough to compensate for all of your risk that you're taking.
You're exactly. If anybody has questions, feel free to type them in the chat. We're going to check out some potentially some charts on some currency pairs. But Walker, you were also a research analyst for another large firm, brokerage firm. What did you do as a research analyst? Like, what does that consist of?
Yes, I was a research analyst for dailyfx.com, and they are still the research side of IG markets. And again, day to day, vastly different from the brokerage side of the business. Because the brokerage side of the business, you're working with the individual clients, you're on the phone, you're working with individual traders. Whereas a research desk, you're sitting down and your focus is to really write up and also draw up major market trends for publication.
Okay, so I mean, you probably had knowledge on every country, every currency around the world, and you just put together was it like a newsletter type thing?
Well, not necessarily newsletters, but there is some of that. Part of it is just for internal purposes. A lot of the brokers get their information handed to them from research analysts. And again, what currencies are in play today? What markets are moving? Then it goes for public consumption on the web. And a lot of that is used for trading guidelines, but brokerages also use that for lead generation purposes.
Yeah, that's interesting that you say that because I mean it's the brokers, the banks, the institutions, they're always consistent in the financial markets. The retail trader typically isn't. And part of that is they had people like you doing all the analyzing, research and everything. They're paying people to do this stuff so they can make their trades and investments. Well, the good thing about trading and investing is we trade off a chart. And the institutions typically leave a footprint because they're moving millions and billions of dollars, right? I mean, you've probably seen, millions and billions of dollars moved, especially in the Forex market per day, haven't you?
Yes, absolutely. And it really has to do with the time of day as well, because the liquidity footprints are going to be much larger in Asia when you see less traders online. So you really have to be careful. This is specifically aimed for overnight traders.
Hmm.
If you start seeing aggressive moves overnight, you better watch out because there's probably somebody bigger and badder than you lurking out there in the background.
Got it. If you want to pull up your chart, and as we're doing that, I'll kind of explain a couple things here. I'd like you to analyze maybe a pair or two, and maybe we can start with maybe that Australian dollar that you're talking about. Just as we go through that, I mean, what explain on a chart what people are typically doing when you're mentioning picking tops and bottoms, and then just kind of analyze what you may do in a trade or investment. And everybody knows that there is risk in trading. This is strictly for entertainment purposes only, mainly our entertainment, but but just kind of analyze that. Do you have a tough time getting your chart up?
No, I'm just pulling it up right now. Let me
Oh,
take
got
the
it.
screen from you.
Yeah, and as
Yes,
you, oh, go ahead.
when it comes to these graphs, I think the average trader gets too wound up in a particular bias. And what I mean by bias is think of like Tesla, right? You think Tesla stock's got to go up, it's got to go up, it's got to go up. You wake up in the morning and Tesla stock is crashed 20, 25%, whatever it did a few months
Yeah,
ago.
that gut feeling, right?
That's right. Well, what happened in the Aussie dollar is that we had this great trend down. Now, prior to this downtrend that I'm drawing now, the market was doing what? Going up, 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 up. And we had a long cycle
Hmm.
of rising prices. Well, what's happening is your average trader is starting to sell and they get stopped out all along this streak. When the market dips, okay, and we make our first lower low, traders then think, oh, this is a great chance for me to buy into this uptrend. And typically that's a good thought. But when the trend reverses and starts going down, now what's happening? You're stopped out of your long positions because you got into this uptrend way too late.
At the end.
That's right. And the cycle starts happening over again. So as the market goes down, what happens is they're on the wrong side of the move and it reverses again and it's a vicious cycle. If any trader finds themselves, and I've worked with a lot of traders in my time, you start getting that feeling that the market just isn't going your way, or maybe it's thinking something that you're not, you're probably right. And it's probably the shifts in the trend that are catching you off guard. Much like this drop here in late September, right?
Yep.
Going back down, traders were looking at this and saying this is a big downtrend. The market is dropping. Sell, sell, sell. And then after that 350 pip move, what has the market done? It's gone back the other way.
Hmm.
I guess the biggest takeaway is that these trends, they're kind of like water. They're going to ebb and flow, but you never want to fight the market. And if you find yourself consistently being stopped out and fighting the market, then go back to a higher time frame and just look at the big swings.
Okay, so you're talking a lot about emotion then. The retail trader is typically emotional in trading and investing. And I know you've taught thousands of people trading strategies and stuff over your course of your time. What would you say that, if someone's having a tough time with emotions, how would you coach them or what would you do to help them, I guess, disconnect from those emotions?
I have to say first, if it's getting too emotional, step back. And there's a lot worse things you could do as a trader than just closing out and taking some time off. And that's part of the lure of Forex is, oh yeah, it's 24 hours, 6 days a week. It can get intense.
Yeah.
But again, if you find yourself buying and the market going down just for you to sell to see the market go up, and it seems like every turn you make is off, back away. Give it a week. Let these trends develop. Take a bigger approach and start fresh.
Got it. Now, just kind of shifting gears a little bit. I know you do a lot of equities trading as well. I want to talk a little bit about the equity market, the S&P 500, for instance. I mean, we're close to all-time highs again. I mean, the market did a nice little drop, and we've seen some more buying pressure coming back into the market, excluding today. It's down a little bit. What do you think is some of the reasons of that? I know we talked a little bit about the election that could be, causing some of the volatility as well. What do you think is some of the reasons we're seeing this market go back to all-time highs, and what do you potentially see in the future?
Well, there's several things that I'm paying attention to. And first, it was this 88.6% retracement. And for those of you that are interested in timing market retracements or turns, the Fibonacci retracement tool and extensions are definitely going to be your best friend. And it's consistently something that you're going to see on research desk across the biggest brokers out there. Now, for me, what's caused this turn is actually several fold, right? The big headline risk is obviously the election.
Yeah.
And again, I don't care who you vote for. You have to know at this point in the cycle that regardless of who wins, it could be risky in either direction.
Yep.
So I think you're seeing traders just taking a breath and taking profits off the table prior to the election, because this has been a phenomenal run in the last month, going from 3,200 to 3,550 and change. Who wouldn't want to book some profits, or do you just let it ride and risk and hope that it goes in your direction?
Hmm.
And this is the other thing that institutions do. They lock in profits. Of course, they've got large base positions, but they're not afraid to take risk off the table.
Got it. So this potentially could be not necessarily selling short the market, covering their or closing their positions out essentially.
That's right. They're covering their positions. Again, institutions are in the business of making money time and time again, and that comes from proper risk management. And with that being said, yeah, there's a strong possibility that we pop up to all-time highs, but institutions are looking at this from a long-term time horizon. They're not worried about the 50 points here, okay? They know that they can pick that up on any given trading day. The risk is in an outside loss to the downside, and that's what they're really trying to protect at this point.
Got it. You said a key term there. You said the institutions are in it for the longer term, right? And that is what we're told in the public as the average investor is buy and hold for the long term. The market goes up. It'll always go up over time. You should have better returns or some sort of return. Now, there's a big disconnect there, though. There's a difference between buying and holding at any price or buying low and selling high. So, kind of explain the difference there.
Well, when you think of buy and hold, most people think of their 401ks, their retirement, and they think, I'm just going to buy once and hold on, which going back in the history of the United States stock market, not a bad idea. And this graph just goes back to 2017, and you can see if you bought and hold, you did all right. But the thing about it is, there are some really big drops here that sets you back. And the difference between the average trader and institutions is that the institution doesn't have to settle for suboptimal returns, or they don't have to wait 4 or 5 years to make their money back, because they have plenty of cash to do what? Look for these areas and start to reposition or average into certain aspects, which really keeps them from taking catastrophic losses, and it keeps them from having multi-year turn downs in their portfolios, which is certainly important.
Oh, definitely. Yeah. I mean, because like to say, for instance, the drop in 2008, it took roughly 5 years or so to get back to where the average investor broke even. Where the institutions, they're not just holding and waiting for that recovery. They're buying at low wholesale prices again.
That's right. And that's their whole goal, is to find these areas. And they're making money again by holding inventory as well for their clients. So they actually have that benefit as well in their back pocket. So not only are they holding shares for you to trade, but they are accumulating the quote unquote war chest for the next bull rally.
Yep. And that one thing that we cannot get back is time. And that's the problem is over time. If you put a percent marker out from 2000 till now, I would assume there's probably like a 200-300% gain or something like that from 2000, the high in 2000, from the high in 2000 till the price now. Over that period of time, if you divide that into 20 years, that annual rate of return really is probably only about 5%.
Yeah, it's about, again, I can't quite line it up, but it's about 160%. We went from, I'm more of a raw math guy than a chart percentage guy. We went
Yep.
from 1570 up to the high 35. So you're talking nearly 2,000 points there. So yes, you doubled once and then a time and a half. So about 160%.
Yeah.
And that was over the course of 14 plus years.
Yep. So basically, it's a return that we're all conditioned to think is good because that's what the market's going to do over time. But there's opportunities in down markets. I mean, just real quick, mention, a lot of our viewers may not know what shorting really is. Explain what shorting is.
Well, shorting is when you're actually borrowing shares, okay? And this is one of the things that you got to get your head over, and it's a lot more simpler in foreign exchange. But what's happening is you're suggesting that the stock is going down. Well, somebody else actually owns that stock in anticipation of the market going up,
Mm-hmm.
and they're holding regardless. So you actually capitalize on someone else's loss. And as opposed to that going on the broker's book, that actually gets netted out into your profit statement.
Got it. So basically, investors are able to open a position on a high note and close it as it's dropping. The difference there is the realized profit once you close it out. So the concept doesn't make a whole lot of sense, but if you think the market's going to go down, investors can short the market. So it's just another direction of trading.
Yes, it's absolutely true. And again, to take it one step further, a lot of traders that are looking to downsize risk will actually use options to go ahead and lock in specific prices in the market. If the market doesn't drop, fine. The option's worthless, move on. But in a catastrophic loss scenario, you can actually profit quite well with put options.
Got it. That'd be a great topic for our next show, Walker. I know you got a busy schedule, so maybe in that next show we do, we can tackle some options. But you have a few things that you have going on right now. Obviously, you have your Twitter account. It's at Walker England FX. You have a newsletter you do, which people can gain that newsletter from going to your email. It's wenglandfx@gmail.com. But you have something big going on next week, right?
Yes, and I'll tell you this, on the brokerage desk, my nickname was the hardest working man in Forex. I do have quite a bit going on, but yes, coming up next week, I know a lot of traders are interested in MT5, so I'm putting on a free webinar to discuss MT5. This will probably be a 2 or 3 part series. And the idea is just to help traders get up to speed with this new software as quickly as possible.
Got it.
And if you're interested in joining in, what I'll do for the YouTube crowd is I'll actually post this on my Facebook group. And this is the Walker Texas Trader Facebook page. And this is where we talk charts. I put all the latest interviews. So I'll put the MT5 one out today and all sorts of good stuff. So your viewers can check that out whenever they would like.
Awesome. And that's Wednesday the 21st, right?
Yes, it's going to be on the 21st, and that is at 9 p.m. Eastern. If you can't make it, I still want you to participate, because what I'll do is, if I can, I'll send you the email with a recording, and you can watch it whenever you'd like.
Nice. And then do people subscribe to your newsletter? Is that that's through your email, right? Or can they find that on your
Yes.
Facebook as well?
Mhm. If they use that wenglandfx@gmail, they could get me, and I'll send them links for everything, or go straight to the Facebook page. That's fine as well.
Got it. Is that weekly or monthly, or how do you do that newsletter?
The newsletter typically comes out on Wednesday, or excuse me, on Tuesday, and Tuesday afternoon I'll push that out. So it is a weekly newsletter. The reason why I'm getting ahead of myself is Wednesday I actually publish analysis on penny stocks in a separate newsletter. So
Nice.
two newsletters now, one on Tuesday, one on Wednesday.
You're doing everything around town now, aren't you?
I'm keeping busy, trying to anyway.
Got it. And you teach classes as well for Online Trading Academy, don't you?
Yes, again, I know class isn't quite what it used to be with quarantine, C-19, and all this good stuff.
Yep.
But I'll actually be back in class next week out in Milwaukee. So if you're out
my
in
neck of the woods.
Wisconsin, look forward to me coming to your center shortly.
Not too far from where we're here in Minneapolis. So I appreciate you coming on the show here, Walker. I know you got a busy schedule. It's great to have your insight on, I guess, kind of behind the scenes of trading and investing. A lot of our viewers kind of want to know more about that stuff. So I appreciate your insight on that. Make sure to give a thumbs up to the YouTube here. Also subscribe. Check out Walker on Facebook, Twitter. Twitter is at Walker England FX, and check out his newsletter. Appreciate everything, Walker. Until next time, retire young, my friends.